Hello friends, I am Dr. Prashant Parate. I am an orthopedic surgeon and a share market enthusiast. I am not SEBI registered analyst or advisor. Please go through this disclaimer.
So good evening and welcome to this Dr. Finance 5th episode with Prashant Parate and Dr. Sachin Kale and Dr. Hemant Patil. And we welcome all our viewers on Ortho TV and Dr. Finance, and let's look at this very interesting topic of how shares prices fluctuate or go up and down. And I think it will be a very interesting evening for all of us. So for further proceeding, I'll hand it over to Dr. Prashant. Over to you, Prashant.
Thank you, sir. Hello friends, welcome to today's webinar. Today we are going to discuss about why share prices rise or fall. This is one of very common question which is asked in many groups. This share is rising rapidly, why is it so? Another share is falling rapidly, why is it so? So this question comes in many groups and very regularly. We'll discuss about why share prices fluctuate and I'll give my perspective about it. So main reason behind fluctuation of share prices is fight between buyers and sellers. There is law of demand and supply. It plays big role and we'll discuss how it has big role in it. Then there is another law of cause and effect. And cause and effect means when there is accumulation, the cause is built in accumulation. When large institutions are buying, they have some cause and it can be seen as an effect. The share price movement is seen as the effect of that cause built. And the next question which comes to mind is who are buyers and sellers? So a person who is holding share in demat account can sell shares, and anyone who has demat account and money to buy share can buy shares. So anyone can be buyer of a share who has demat account, and people who have shares in their account can be a seller. In US there is another law where they can borrow shares and sell them, and positionally selling is possible for them. In India, it is possible only on intraday basis. Positional shorting is not possible. So this is one thing. Then there are different categories of buyers and sellers. We are commonly known as retailers who have less number of money, and there are small institutions who have larger amount of money than us. Then there are big institutions, large institutions, which we commonly call as FII, DII in India. Warren Buffett is a kind of large institute. So these are large institutions and they decide prices, where price will go. Will it go higher or lower? So these are people who decide and manipulate markets according to their will. Now let us see how retailers buy or they invest in shares. Usually they buy in SIP mode. They fondly call it as SIP mode, where monthly fixed amount or fixed quantity is bought. For example, somebody may be buying 5 shares of TCS every month or 1 share of TCS every week, or maybe he is investing 5,000 rupees every month in particular share. So they call it as a SIP mode, but actually it is automatic investment. It is not systematic investment. Systematic investment is kind of bulk investment at appropriate places. Then other method by which retailers buy is buy on tips from different groups. They see that somebody is promoting this share. This share is likely to go higher. They have seen that last 3 shares which that person has said has gone higher. So next time they try to buy tips from that person and they invest on tips. Then there is another way of buying on news, like some some pharma company comes out with new molecule and this is good news, so many people try to buy that share. Some company comes with vaccine for corona and people try to buy at that level. So this is kind of buy on news. The rule in stock market is buy on rumors and sell on news. Then they also buy in euphoria when all the stocks are going higher and higher. Then they think that markets are not going to stop anywhere and they're always going higher. So they start buying in euphoria. Then is it possible that retailers can increase share prices by their buying? Usually retailers are unorganized and they do not have any effect on share prices because they buy 1 2 shares or 5 shares, at the most 1000 shares. So that is not going to cause any effect on share prices. Most of the times volume of total volume of retailers combined is less than 5% of stock market volume. So just 5% volume which is unorganized cannot cause any price fluctuations, because there are more than 7000 companies and all people are investing in different companies. As volume is scattered and not well directed, it does not have any effect. There is I'd like to share this example of GameStop Corporation. It is very rare example where retailers came together and they increased share prices. So this is a chart of GameStop, and many big institutions were selling this stock shorts. Short selling was active in this share, and some retailers came to know about this thing, that there are heavy short positions built in GameStop Corporation by large institutions, big billionaire fund houses. And then they found out that this is very low price stock and it can be manipulated if many retailers come together. So they started buying it and they gathered some people on social mediums. Then with social media help, the stock started moving, people started joining hands and there was buying. If you can see, people started buying at these levels and volume started coming up, and it was up in uptrend on daily chart. So at this point when price was 19.95, I think it was on Reddit forum where many retailers started to join together and they bought in bulk, and immediately share price increased from 20 to almost 38. So this was huge increase in price. Maybe this was because of short covering of large institutes also, and buying of people also. So they combined their forces and started buying GameStop. This was not the end. Fun started after this, and after 3 4 days consolidation, more people started buying, and the all-time high levels were broken. At this point, institutions were in panic because all their shorting positions since 2014 were in losses. They had big positions which they cannot exit immediately, so they had to wait, and they thought that prices will come down, but retailers kept on buying, so prices went above their shorting level. Now these people have pressure to give delivery, and that causes short covering rally. So once prices went above all time high, there was big up move. Next day there was gap up and it opened at around 96 levels. It fluctuated high up to 160 levels and came down, but there was still continuous buying. And then all the institutions had to exit in panic. If you can see, it made high of 483 from levels of 20. So it is almost 23 times gain in 15 days. This cannot be explained on basis of fundamentals, because there was no change in fundamental. So this was totally based on technical analysis and short covering, which is a technical phenomenon. And after making high, it came down rapidly within 15 20 days. So if somebody is relying mainly on fundamental analysis, this kind of move is not possible to catch, and this is one of very rare kind of moves. This does not happen very frequently. It is not always possible to manipulate things using social media, but big institutions do this regularly because they are well organized and they have funds to do so. Then let us see how small institutions and professionals buy. Usually they are called as smart money. So there are many people who buy based on trend and they are called as trend followers. They have fixed rules for deciding trend, and they buy as per trends. So uh, we'll discuss about this chart. This was a big buying in IPO of Awas, and after a few days of consolidation, stock prices went down. Can you see my marker? So stock prices went down, and gradually it came down to previous resistance level, and it broke the resistance. So at this point of time, there was high, low, and higher high. And this is definition of uptrend. So many trend followers started following this stock, and once the fall came, they started buying here, and they started buying here at breakout levels, and prices of this stock went on increasing rapidly. So once daily trend shifted to uptrend, there were a lot of buyers who followed trend, and they moved the stock prices higher. They kept on buying every day. That's why prices went higher. And then on larger time frames, weekly time frame, this is uptrend, and many people are buying on uptrend in higher time frame. So prices are moving higher and higher, making higher high, higher low. This is basically trend following buying. Then there are people who buy on reversal, and they are called as mean reversion traders. So they have demand areas, supply areas, where they, in demand areas they buy, and in supply areas they exit their profits at profits. So here they must have bought thinking that trend is, there is some demand area here, and price will at least go till this level. At these places they sell, they do short selling, and here trend is up, so they try to buy at lower levels, buy on dips. So these are kind of reversal players. They are called as contrarian traders or mean reversion traders. So usually these are smart people who know at what level there are higher chances of prices reversing. Then there are different kind of smart people who know how to find out there is institutional involvement, and they try to uh, take positions at the time when institutions are ready to mark up the stock to higher levels. So this was a chart of Havels which I had shared in groups. Here around June, I had bought this stock at around 988 levels, and stop loss was around 955 with target of 1230, 1220, 1230. And I bought at two levels, once at 988 and another buying level at 1010 here. From that point, it went on increasing very rapidly and gave my targets. After completing my target, it went sideways, and now again it went higher and higher. So this is kind of timing where some people rely, and this trade almost gave almost 1 is to 9 times, means 9 times reward than what was initial risk. So many people rely on this kind of method. These are small institutions and smart money, which the way of their buying is this. Then there are large institutions, and they buy very differently. They have large amount of money, and they cannot deploy their money at one particular point. So they have to use different levels to buy, and they keep on buying when prices are falling. If they start buying in bulk immediately, then prices will increase. So they need time to accumulate for making appropriate position size as per their capital. They have huge capital in billions of dollars, and they need at least 2 to 3 months of time for accumulating their position in that stock. So it takes time, and once they have accumulated their stock, they need huge liquidity also. And without liquidity, if they try to buy, prices increase very rapidly. We'll see this concept in detail. They have value area where they buy. They do not buy at any XYZ level. They decide that if some stock is at 100 rupees and their value area is around 40 to 60 rupees, they buy only when stock comes to 40, 60 levels. Otherwise, they are not interested at all in buying that stock. So they wait till the value area is reached, and they need huge liquidity. So usually they buy in panic time when there is bad news and stock prices are falling very rapidly. So what happens during such time is many people start selling their stocks at whatever prices they get, and there is huge liquidity, there are high volumes, so there is good selling pressure and large institutions can absorb this selling pressure. They have uh, amount of money with which they can manipulate the stock, and they know which stock they want to manipulate, so they start accumulating that stock. And when people are selling rapidly and aggressively, they start buying rapidly and aggressively, so that their buying does not cause any increase in price, but it stops the price fall. So this is kind of buying at first phase where the stock is falling and they start buying in their value area. After they start buying, price comes in green area. Otherwise every candle is red, but once they start buying, it goes green. And once they see that prices are going higher, they stop buying. Then once price goes beyond their buying area, they sell, because if it goes higher, then they will not be able to buy it, and if uh, does not come down, they will not be able to accumulate their appropriate position. So they start selling so that prices come down, and once a price comes down, they start accumulating again. After their accumulation, price moves higher again, and if their position size is not complete, they sell it. So there are multiple tests in accumulation, and after the final test, when stock is accumulated appropriately by institutions and is ready for markup, then they start buying even when prices increase. So with small buying also, there is big effect on price, and price keeps on moving higher and higher. That's why they do not allow initially to the prices to go higher than their buying area, and once their buying is complete, they start buying so that prices go higher and they make profits. Then there are different methods by which retailers sell. So how do they sell? They sell with small profit targets, like if I gain 5,000 rupees or 1,000 rupee, I will sell the stock. There are some traders or investors who have bought it at higher levels, and there may be correction after that they're buying. They might have bought at higher levels, and there may be 30-40% correction, 50% correction, and it is big fall, so that trader is really afraid. So when prices come back to break even levels, then they sell it, and they feel very happy that at least I got back my money. Then there are some retailers who sell in panic when market crash happens. Like recent Corona event, there was rapid fall, and lot of people might have sold their holdings during this crash, fearing that it may go down and down. Like previous 2008 event when it went fell around 68%. So people might have been afraid that this time also it may happen, and they might have sold. Then they sell at fixed percentage profit. Some people have a rule that I will buy and I will sell at 5% or 10% or any amount of percent, and I will not keep stop loss. So this kind of method is also followed by some people. So till the time everything is based on rules, it is okay, and all the rules, if followed properly, can give appropriate returns. But many retailers do not have any rules and they sell randomly. I bought here, I will sell here. There is no thought process behind it, and such kind of investors don't gain much. So, if rules are followed properly, whichever the rule may be, then person can know that this rule is good, this rule is bad, and it can be changed. But if there is no rule, then it cannot be changed. Then there are small institutions and smart money who sell with change in trend. The people who are following trends, they exit when trend changes. Then there are people who sell at supply areas like contrarian traders and mean reversion traders. Then there are people who sell asset if asset is not performing as expected. Means somebody has bought thinking that institutions have accumulated and now it is going to go higher, and that stock does not perform for 10 days, 15 days, or whatever time frame is pre-decided. Then that person exits or that institution exits that asset thinking that this is my time stop and I will exit because it is not performing as expected. So basically these smart people and institutional people have rules and they follow those rules. Then there are large institutions, and large institutions need huge liquidity when they are going to sell. And they do not sell very easily. If they have accumulated over a period of 2 months, 3 months, or 2 years, then they keep on holding it for longer duration of time. And they want good liquidity at the time of their exit. Because without liquidity, if they start selling, then prices will fall very rapidly, because they have lot of shares which can make the markets crash. So they need good liquidity at time of their selling. So what do? They sell in strength. When the stock is rising very rapidly, then they start selling, and their selling causes buying climax. They sell on strong news, because at strong news many small institutions and many retailers are interested to buy, thinking that this news is going to give this stock 10% 20% more returns from here on. And institutions, large institutions, are already holding that stock from very low levels, and that may be giving them 400 500% returns from their buying level. So they are not bothered about 10 20% more gain from the high levels, and they are willing to sell because they get good liquidity in strong news. So they exit in strong news. That's why we can see that there is high volume at such strong news. When prices are moving higher, there are high volumes in candles. Then many institutions sell if their view is changed for long term. Suppose they have thought that this company is going to perform well in future, but it is not performing, or the management has changed. Then the view of that institution is changed, and at that time they exit at market level. They do not wait for any prices. They just trigger their exit, and all the stocks are exited in single click. They don't wait for prices to come up or down, because large institutions are market makers. They don't watch any charts. Then let us see why prices rise. This is the most common question and very important question. So price rise is because of demand and supply rule, which I have said earlier. When demand exceeds supply, then price increases. So I will take one example here about, for example, water. If there is, suppose there is one city where there is no water source in city, and water comes from other city or nearby town where there are lakes, and this city requires 120 trucks of water daily. This is just an example, and that city is getting only 100 trucks. So already demand is more than what the supply is coming. So because of this, prices of water, or that trucks of water will not decrease. It will just keep on increasing, because demand is more than supply. So what will happen if somebody is not getting water? He will try to find another source from where he can procure. So this way, when demand is higher, then prices will increase. Then what happens? There is increase in demand. Already demand is higher, but there is constant increase in demand, and supply is fixed. So in this situation, price increases even more. In this example, same example will continue. There was requirement of 120 trucks of water, and the city adjacent to this city has even less supply. So what do people in that city do? They know some people here, they come to this place, and they visit their relatives so that they get some water. This is summer season, and they think that it's okay if we go to our relatives, we'll at least have some relief. And from 120 trucks of water, demand increases to 125 130 trucks, and supply is fixed. It is just 100 trucks. So demand has increased, and supply is fixed. Prices are going to increase, because this extra trucks number of trucks people will start searching for sources from where they can get it, and they will pay higher amount of money to get it from black market. Then what happens? The next thing is supply is decreasing and demand is constant. So these people who have visited here, they are staying here, but heat is increasing, and nearby cities water reservoir from which water was coming, there is decrease in water, and supply has decreased from 100 trucks to 90 trucks, 85 trucks. So already there was increasing demand, and now supply has decreased. This will cause panic, and uh, everyone will start looking for alternative water sources, and there will be increase in price of water. Then with this constant rise in supply, there is constant fall in with constant rise in demand, there is constant fall in supply, which will even increase the prices even more. And ultimately, if there is demand which is constantly present but there is no supply, so suppose some big businessman came and he took all the water in those reservoirs and bottled the water, and he has hidden all the water, so there is no supply now. Everything is taken up by that big person, and there is no supply. So what will happen? Their demand is constant but nobody is getting water, which was coming earlier with trucks. Everybody will start looking for water, and whatever water they get, they will be willing to pay any amount of money. They will pay whatever they have, but they will need water, they will buy water. So when there is no supply and demand is present, prices increase very rapidly, very aggressively. I'll show this on chart. Just a minute, I will have some water. Sorry. This is chart of Orchid Pharma, and in November 2020 price was around 17.15, and in April 2021 price is around 2588. So in 149 days, there is increase in price 149 times, or 14,992%. Is there any change in fundamental in this company during this period? No, there was no change. And what happened? How many shares are being bought or sold? Just small number of shares, 1000 shares. Here maximum I think was 14,000 in this candle, but number of shares being bought and sold is not big. So all the supply has been dried up, and there is demand, constant demand. That's why price is in upper circuit every day. Every day it is going higher, 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 and higher. So this is what happens when there is rise in demand, or there is no supply and demand is present. So this is the way prices move. This cannot be explained on basis of fundamental analysis. This is purely demand and supply. So how did this happen? Why prices were at 17 level and then they went on to create a high of 2588? Answer lies in this. This is shareholding pattern of Orchid Pharma, and if we see investors, in June 2020, promoters were holding 26.68% of company share, and public was holding 68.8% of total number of shares. So if public is holding 68.8%, then it is all supply. Public can sell anytime, and they don't have any rule. So they can sell anytime in panic. In September 2020 also it was 26.68%. And what happened in December? All the shares were bought by promoters. They got their stake at 98.07%, and this public stake was decreased to 0.88%. After this, what happened? You have seen in the chart, prices went on higher and higher. So here if we can see, in December and March, there is no change of prices, no change of holding for investors. There is no change of holding in FIS. Only changes DIS 0.1% decrease, and public has increased it by 0.1%. So just exchange of 0.1% shares has caused 149 times increase in price. This is amazing because there is no supply. Supply has been, promoters are holding all the supply. They are not selling. Who is selling? Just DIIs are selling, and they are selling just 0.1%. So even on 1%, they have made 149%, 149 times in 149 days. So this is a kind of magic of demand and supply. And once in June 2021, promoters exited 8% of their share, prices came down very rapidly. So even with 8% share, it came down very rapidly. But 8% exit did not cause any harm to them because already prices had increased 149 times. So promoters have made more money than what they invested in buyback at this level. This is very important concept to understand. Then how much do prices rise, or in short targets? Usually prices rise till a strong supply level in history. There are supply zones where previously some sellers have sold, or there was a large supply, and when price markets have memory, so when prices reach again at that level, they start selling their shares, and there is supply available. So this is one level where prices can rise. Then if market is in high all time high levels, then prices go on increasing till the time large institutions want to sell their holding. If fresh supply comes in market, only then prices decrease. Otherwise, if there is no supply, price can go on increasing till any level. Then there is another target which can be calculated using point and figure chart, and it is based on cause and effect. The accumulation phase has cause in it, and it can give targets based on point on figure chart calculations. Then there are different methods like Fibonacci extensions, harmonic pattern targets, and other patterns like cup and handle, head and shoulder, or flag and pole. These kind of charts, or box breakout, triangle breakout. So these are other patterns which can give projections for targets. Then let us see why prices fall. This is also very common question. If price is falling, why is it falling? So similar to demand, supply, when it is reverse, prices will fall. If supply exceeds demand, then prices start falling. Many times prices of onion go beyond 50 rupees, 100 rupees, and when fresh crop comes, supply exceeds demand, then prices start falling. When the supply is constant and demand is fixed, there is supply increase in supply and demand is fixed, even then prices will fall. And when constant supply is increasing but demand is decreasing, then that time prices fall rapidly. And when there is no demand at all and there is constant rise, then price falls very rapidly and it goes in lower circuit. If there is nobody buying, then prices, there will be sellers, and even one stock selling will cause decrease in price. And such at this time, stocks go into lower circuits. It can go to zero also. So this is common thing in many stocks. They keep on going in upper circuits and lower circuits, and it is better not to invest in such kind of stocks because even small amounts we cannot take entry, we cannot exit. So it is better to avoid such kind of stocks which are moving in circuits, higher circuits, lower circuits. Many people show examples that I am buying at this level and the stock is moving so rapidly. Every day it is in upper circuit and it is going to from 100 to 200 levels. But usually at the time of entry, one can get only few shares, maybe 5-10 shares, maybe worth 5,000, 10,000, not more than that. So if somebody gets stuck, then that money is lost. So these are reasons for price fall and price increase. How much do prices fall? Similar to the rise, there are targets for fall also. And prices can fall till the level of strong demand in history, or till the time fresh demand is provided by large institutions. Sometimes there is no demand areas, and institutions come to know that this particular stock is very good at this valuation, and they start buying immediately. So there is fresh demand at unexpected level, and that can be the final target. Then they go down till the time the targets of distribution is completed. So it is also calculated on point and figure, and distribution also can be found. So there are also Fibonacci extensions, pattern targets, everything. And maximum fall in stock can be up to zero levels. Below zero, it cannot go. Definitely, there was an example of crude oil futures which went below zero, but that is a very rare example and it doesn't happen regularly. Any share price will not go below zero. Zero is the limit, but there is no limit for higher side. On higher side, it can go on increasing 150% or 1000% or 100 times or 200 times or 1000 times from original price. So for higher side, there is no limit. For downside, there is 100% limit. In conclusion, prices keep fluctuating based on demand and supply. Large institutions control prices and they work on larger time frames. Smart money control prices at smaller time frames because they have smaller amount of money and they keep on taking entries and exiting their positions. So they control prices usually on smaller time frames. Nobody is interested in what retail investors are doing because retail investors have very small amount of money. Large institutions want money from other large institutions and smaller institutions. Small retail investors are just 5% or maybe even less, and nobody is interested in taking stop losses of these people. Large institutions try to take stop losses of small institutions working on smaller time frame. They move the prices so that the stop losses are hit on smaller time frame, and then again trend continues on larger time frame. So that way these manipulations work and everybody works on their own time frames. Thank you for your listening. That concludes my talk.
Thank you, Dr. Prashant, for such an elaborate discussion on this topic. What I want to know is there any particular level of volume you watch for? Say, volume of last 5 days, volume of last 1 year, volume of last 3 months. Is there any such criteria to watch for?
Actually, there is theory of V's wave volume where volume in trend is checked, and at every uptrend, every swing volume is calculated and measured. And there is also another level where if there is high and there is low, then volume at that levels is checked. According to Wyckoff, there cannot be a successful breakout with smaller volumes. If suppose one share is moving from 100 to 120 levels, at that point it has moved and it has made a high, then it came down to 120 from 120 to 105 levels. Then next time when it is going at 120 levels, volume at that level is important. If that volume which is uh, in the candle crossing 120 levels, if it is less than the volume of candle which formed high of 120, if it is less than original volume, then there are high chances that that kind of breakout may fail. Wyckoff says that it requires equal or higher volume to break the structure, to break previous resistance and make new highs successfully. So that is one thing. Then there are different volume profiles, uh, different characteristics of breakout that need to be studied with help of volume. So there is no particular time period. It depends on what time frame we are checking the chart. For weekly chart it will be different, for daily chart it will be different, and for hourly chart it will be different. But as price is fractal and it shows same kind of price action in all formats, all charts. So we have to check volumes as per time frame which we are using.
Any particular time frame you prefer for long-term investment?
For long term investment, weekly is my best time frame.
And by investment perspective, what time duration are we looking after?
I don't do much of investments, but for investment, we must invest in those companies where large institutions are investing, and large institutions need lot of time. Sometimes they require 6 months to 2 years duration to acquire their appropriate position size. So you may have seen that there are many companies which remain sideways for very long duration of time, and then once they start to break out, they increase very rapidly and they keep going higher and higher, maybe 400 500% times.
Recently, we saw example of Reliance in this case. During the Corona pandemic, it gained multifold. It almost doubled within a short span of time.
Yes, but that was not very good accumulation. There are some other companies. I will share the charts of those companies which had very good accumulation, and once there was breakout, they went on higher and higher, maybe 400 500% gain in those companies. So longer the duration of accumulation, higher is the chance that they will keep on increasing. That is called as markup phase, and there are huge targets when accumulation is for longer duration.
Okay, thank you.
Do we
Yeah,
have
Prashant.
any questions?
Yeah, Prashant. Thank you. Very nice lecture. Prashant, like predominantly for a trader or maybe a positional trades, like which time frame will be much proper? Like,
See, positional trade and swing trade, these are very commonly used terms. But
Mhm.
main thing is swing. What is swing trade? If we are taking we are checking 5 minute chart, then from low of there are highs and lows. So from one
Mm.
low to one high, it is one swing. And
Okay.
from lowest point of lowest point of chart to highest point till before reversal, that is one positional thing. So it can be on 5 minutes also, it can be on 1 minute also. Same term can be used for hourly chart also, and daily chart also, weekly chart also. Swing trading and positional trading is misnomer. What we want to know is whether which chart we should check if we want to keep position for 7 days, or if we want to keep position for 1 month,
Okay.
right? So if we want to take a trade which will last for 1 month, primarily weekly chart is useful for knowing the direction, and daily chart is useful for taking entry. If
Okay.
we
So
want to keep
specific.
it for if we want to keep it for few days to a month, then daily trend is important, and we can take entry on 75-minute chart or 15-minute chart.
So roughly, and what are any specific indicators you prefer, like for a entry in the stock? I know
I don't
predominantly.
use any indicator because indicators are not good for taking entry. They are usually lagging indicators, and
Okay.
most of the times they look very nice on charts, but in reality, when we do back testing, then they
Mhm.
don't give very good results. So I have stopped using any indicator. Sometimes I use RSI indicator only to check if the reversal point is appropriate as per my analysis. Very rarely. Most of the times I rely mainly on price action and volumes and market structure.
Predominantly RSI when the it is in overbought zone or oversold zone something.
Yes, because in oversold area people sell and in overbought area people buy. And
Okay.
that is only followed when we are following the trend. If we are not following the trend, then this does not work. Means in uptrend, if we try to sell in oversold area, that is going to fail. But
Okay.
if it is downtrend and there is oversold area, then there are good chances that stock will fall from that level. So primarily it cannot be used, but it can be used in conjunction with the structure, market structure and main trend.
Okay. Thank you, Prashant. Thank you.
Do
Is there
we
any
have
questions from audience side?
No questions means everything understood.
or nothing understood? Everything went above.
Actually, it's quite. I feel it is quite a basic talk. It's nice talk. Means what are the uh, what is the reasons predominantly the buying zone and the sold zone? Good. I think it is more predominantly basic talk. Very nice talk. Actually.
Yes, it is very important topic because nobody knows and they just want to know what is the news behind this. Why the
Mm.
stock is falling? Is there any news? So rise or fall is not always based on news. There are very rarely some great news which come without any prior intimation, like demonetization news which nobody knew and it came all of a sudden and there was fall, but prices came back again. As when there is sudden event and large institutions did not get time to exit their positions or make appropriate positions, then prices come back and then they create their demand area or supply area. After that prices move.
There is a question in chat box from Dr. Kamal. Is there any criteria to select stocks, which stocks to buy?
uh, there are many different criterias. It depends whether one wants to do trading or one is willing to invest. So
May I
accordingly,
rephrase the question? Is there any screener available or particular thing you look into for a stock to select it for further analysis and to buy it?
yeah, there are many things which can be used as a screener. Like if I want to select some momentum stock, then either I try to select look for stocks which are making lows below previous low. Because what do big institutions do? They buy below previous lows. They get cheaper rate and they get good liquidity below previous low. So they try to buy at lower rates below previous low. So that is one thing which I look for. If any stock is falling below previous low, market structure, swing low, and for that I keep on my alerts in system at those lows. Usually I do it manually. I don't know whether there are screeners for this, but one can check for stocks which are making new low in last 20 days or in last 50 days or last 100 days. Because if accumulation is going on for longer time, then maybe a stock breaking 100 days low in sideways trend can be forming a spring. So that is one logic which I use, and I screen for such kind of stocks where I can look for price action. But I do not rely completely on that screener. What I do is, when I get something in my watch list, I keep a watch on that. I analyze the price action. I want to know what is the context on a higher time frame. If it is in higher uptrend on higher time frame, only then it is good to buy. Otherwise, there is no logic in buying a stock which is in downtrend, because we cannot reverse the trend unless there is trend reversal or some large institutions are interested in buying that stock. There is no point in buying it. We cannot increase the price just because there is a good fundamental. There are fundamentals are good. Unless there is buying interest from large institutions, there is no increase in price. Why prices increase? Because these large institutions take up all the supply and there is decrease in supply. They do not exit unless they get targets, unless they get profits. So when large institutions buy in huge quantities and supply is decreased, retailers don't get to buy, and then they have fear that it is going on increasing. Trend followers come and they see that there is uptrend going on from here, and they start buying. So that is the reason prices increase.
Okay, just now you mentioned something about spring when the stock is in downtrend. Is there any equivalent in uptrend?
It is called as upthrust. I'm not saying that spring is in downtrend. Usually spring is good to trade in uptrend. It is stop loss hunting for lower time frame traders, but trend is not changing at that level. So stock is in uptrend, but there is stop loss hunting for lower time frame investors, and then it goes up, goes on to continue its original trend on higher time frame. Similarly, for uptrend to end or in downtrend, it is called as upthrust.
Dr. Sandesh wants to know, is accumulation by large institute is possible in small cap, and is this very regular event?
See, every stock has its individual anatomy, and every investor have their own thinking. Some institutions believe in accumulation, and some do not believe in accumulation. They start buying and they reverse the trend immediately. So there are two types of analogy or theories. One is Dow's theory. It says that market structure when higher forming higher high, higher low, higher high, higher low, it is in uptrend, and structure is broken once lower low is forming, and downtrend is lower low, lower high, lower low, lower high, and uptrend starts only when this structure is broken. So some people or some institutions work on this formula and they change the trend immediately. Then there is another way where there is accumulation to stop the selling. There is selling climax and then stock goes in sideways. It breaks the trend line, still goes sideways, and then after accumulation for longer duration, it goes higher. Stocks can show either of these two things, and uh, it is not predictable. But both the things, if known properly, then it can be traded.
The question was specifically about small cap companies. So
Small cap
any
companies
highlight on this?
Small cap companies can also have accumulation. It depends on how much is the capital, because large institutions are usually not interested in small companies. Large institutions like Warren Buffett kind of people, they are not interested in very small companies. They are usually interested in mid cap companies and large cap companies, because if they want to buy small cap company, they can buy with just less than 0.5% of their capital. So usually they are not interested in small cap companies unless it is very big thing like AI nowadays. So usually they
Or
stay away from small cap companies. Small cap companies
Shanti,
are usually manipulated by people who have less medium type of capital, because small cap can be 2 crore and it can be easily manipulated by people. 100 crore is small cap companies capital, then it can be manipulated by people who have 10 or 20 crore rupees, which is not large amount of money in share markets.
Prashant, you were thinking like means your idea, not idea, advice rather than so small. Stay away from small cap was this one. Like easily manipulation can occur predominantly by
Yeah,
the
manipulation
large.
can be easily happening, and if the companies are moving in circuits, then it is not possible to enter, or it is not possible to exit.
Like example was Orchid Pharma. Like
Yes,
could be
yes.
one of the example.
We
Many
can see
people got
that it
trapped.
has increased 149 times, but how many people could buy, and what is the number of shares they could buy? It's
And
very
maybe they could
negligible.
not, and they could not sell also because of the lower circuits also,
Yeah,
right?
after that it went in lower circuit, so it is not possible to sell. So everything means all is paper gains and paper losses in those companies
Hemant,
most of the times.
uh, any specific indicators or criteria you use like for the buying stocks? Your ideas on this?
regarding what Prashant is discussing, do you want anything from that side?
No, means just I want your like personal like what
Okay.
you do now.
Usually I follow price action as well as simple basic methods which are commonly known to all, that is trend line. I think trend line breakout trades are the one trade which cannot be missed, and they have got excellent risk to reward ratio with minimal efforts of analyzing. So I do prefer trend line breakout trade along with price action trades.
So predominantly these two.
Yes.
Okay. Okay. Thanks. Thanks.
Thank you, Prashant, for this elaborate session.
Thank you all.
Ashok sir.
Thank you, Prashant.
Thank you, sir. Thank you.
Ashok sir, are you there?
No, Prashant, we can ask few questions other than other topics to Prashant.
Yes, definitely.
Always that simple question, like when is market either is going to, we can't time the market, but any specific indicators now in Nifty or something like Sensex is going to go down, but it's going to be stable same way.
I would like to take this. If you have recently seen Nifty chart and Bank Nifty chart, Nifty is just racing around, and Bank Nifty is lagging behind. So there is lot of diversion which is happening. So this is not which is healthy bull run, which I would say. We cannot define the timeline when it will break down, but sooner or later it has to come down. And I expect a healthy correction of around about 10 to 15% in Nifty from present level.
So ideally, bull run has to be in Bank Nifty. Nifty means in short, all the bull run has to be.
Yes, it has to be in each and every sector. So it will be yes.
As you said,
there are always some sectors which are lagging, some sectors which are leading.
Yes.
So,
but considering the economic boom which has been projected and banking sector is lagging behind, so it is not hand in hand. There is like something.
As you said, like 14,000 was a Nifty when it in April, and not in February 15,000 was there, and the Bank Nifty was roughly 36, 37, and which is now behind 2,000 points. And the Nifty has gone 3,000 points up. So it is diversification is completely up.
Okay. So this is called as relative strength, and relative strength of Bank Nifty is right now less than Nifty. But other stocks like IT stocks and reality stocks, they are at a point where their relative strength is higher than Nifty, and they are taking the index higher and higher. So this keeps on happening. One sector goes in lower relative strength, and other sector comes up. Till the time one sector is being replaced, it is called as rotation of sectors. So till the time rotations are happening, index will keep on going higher and higher. And even in sector, there are rotations of stock. So one stock will initially take the lead, then that will go in distribution area, and other stock will take a lead from that point. So it is relative strength of stock to stock, relative strength of sector to index. So that is one thing. Rotations are going to happen. If we want to know when Nifty will fall, then Nifty will give indication for that. Nifty will make a new low, and then it will go high and then fall.
Without making a new high.
Yeah, without making a new high.
Yeah. So it will be.
So usually it takes 3 to 4 months at least for Nifty to go in distribution phase, and only after that it falls. And it may sometimes increase also.
We can be vigilant once there is a lower high which is formed.
Lower low which is formed.
Lower low and lower high, both of them.
Yes. Means one lower low, one lower high, and second lower low.
Yes.
This confirms downtrend.
Change in trend.
Yes.
Okay. Thank you. Thank you both.
Okay. Over to you, Prashant.
I think we can conclude the session as there are no questions.
No questions.
Okay. Thank you.
Again, Prashant, thank you very much for your time and efforts.
Yes.
Thank you.
Thanks a lot.
Thank you.
Thank you, Heman. Thank you, Sachin.
Okay.
Thank you.
Bye bye.